Alright, pro retail traders. Today we're going to talk about crude oil volatility trades. We're going to talk about volatility patterns and how you can use that in trading crude oil news today. Crude oil volatility trades are like any particular volatility pattern. They have contraction and expansion. And knowing the patterns of this contraction and expansion along with volume, you will be able to trade with edge. And if you already are trading with edge, this is something that you can bring to your trading that will actually help you make bigger trades, understanding which way the market is moving with ease and which way the market is fighting. Volatility patterns are contraction and expansion, like I said. When you see contraction, it's sort of like the wallet being squeezed. The credit crunch is on. Contracts are being gathered due to maybe a particular lack of activity or a certain type of activity, and you want to be able to identify that because it happens all throughout the day, multiple times on different time frames, and the gathering of these contracts are what allows the players to eventually turn volatility contraction into volatility expansion and have the old $100 bills falling from the sky. So if you are actually looking to find a channel that's going to help you up your game, then you found it. Here at Pro Retail Trader, we talk about concepts in a way that is applicable to the actual market mechanics and trading conditions to help you trade with edge and to become a better trader. So stay tuned, watch this whole video. You're not going to miss any of it because all throughout I lay out tidbits that will actually help you become a better trader. So like, subscribe, and be sure to hit that share button. It's a little arrow, and share this through email, share this through Twitter, Facebook, or any other social media that you're on, and sit back and prepare to learn. And as always, it's time to get our mind into the trade.
Sitting here every day, when things go badly, if you can't keep your cool at that time, you've got no chance, to be perfectly honest.
In London, some important financial news is due in under half an hour. The latest money supply figures will almost certainly have an effect on the pound, but nobody knows which way. Richard is gambling that they'll send sterling up, so he's bought 20 million. But now sterling is falling as other dealers place their bets.
Yeah. It's just hovering just below my level at the moment, yeah.
Do you want to cut out a bit?
I think I might cut it down a bit before the money supply figures, yeah. You're then gambling on something you don't know about, to be honest.
Alright, pro retail traders, so we're here at the charts, and what we have here is crude oil on a 15-minute chart, and what we have is the 5th, June 5th, where we had a crude oil inventory. So on June 5th, we had a crude oil inventory. So what we're going to do is we're going to look at how does the actual volatility patterns play out in our favor. So I have an indicator up here which actually identifies volatility expansion versus contraction over a predetermined period. So in this example, I have the indicator showing a yellow diamond, as you see here in these candles. You see many of these yellow diamonds. So whenever volatility has expanded greater than the 3 previous candles, it will show me one of these yellow diamonds. Now, why is that important? Well, it's letting me know that the range of prices that are being traded over any given period of time is increasing compared to the last, in this case, 3 periods. You can set the indicator to work at 5 periods, 10 periods. It's all due to preference. It's also due to what time frame you're working on, your style of trading, and also your understanding of volatility patterns with volume. So for this purpose, we'll be looking at the 15-minute chart and the 5-minute chart. But all the things I'm going to talk about, they're applicable on any time frame. Volatility is volatility. It is the expansion or lack of price ranges during any trading session. So let's talk about what we see here on this leg down. This is going to be one of the most simplest examples, and I'm doing this for illustration purposes, but I will go to another day on the crude oil where we also had news, and I will show you how you can use this to work in your favor and gain an edge in trading. So you got to know what you're doing. Just like Richard said, if you can't keep your cool in trading, you have no chance. And sometimes you have to lighten up on a position. So when we look here, most people would say, hey, look, we have a leg down and we have a lower high from up here. As you can see, I'll get my drawing tool so this will actually be a little easier to follow. So we have lower highs right here, right? It doesn't make it back up to the Asian range, high of the Asian range. That's what these dots represent. This is the high of the Asian range. This is the low of the Asian range. That's the midpoint of the Asian range. So we didn't make it back up to the high. And then we break through the low, make a new low. But what I want you to determine here, what I want you to really see is how we're making that low. If you look, the diamonds are only showing up on down candles. They're not showing up on any up candles, which really there's only one here in this case, but that lets you know that we're seeing more volatility, the exploration, the expansion of price ranges to the downside. That is important because that is letting us know where price likes to go. Now, why is price going there? We may not know that, not initially, not without other tools, but what we can use is the volume. So if we just look at this candle right here and we look at the volume, we can see the volume increased more than the last 1, 2, 3, 4 periods. So from the last 4 periods, which brings us back to this candle here, volatility has increased and gone in our favor. So why is this important? Because it's letting us know that the favorable market conditions are towards the downside. Now, how can this help us way beyond the obvious? All right, here's where you're actually going to pick up a tidbit on how not to get lost in the sauce. A lot of times people see patterns, and these patterns, they look like they're reversal patterns and they're not sure. It looks like it's at a reference point, but they're not sure. And a lot of times what they're missing is the volatility aspect of the pattern, which will let them know if that pattern is holding true for whatever reasons, whether it be because there's more buyers, more sellers, the lack of activity, or if it's price manipulation, and how you will be able to tell. So just cruising over here to this pattern, we see we have a shortening of the thrust. So we're coming down, and as you can see, volatility after expansion, we have contraction. That's normally the flow. Normally you have volatility contraction, and then it leads to volatility expansion. And as you have volatility expansion, it leads to volatility contraction. That's the actual cycle of volatility in the markets. We've all seen it from a market profile perspective. You might have a balanced day, and then the following day you may have a trend day, or you may have 2 trend days in a row. And knowing how to trade those a lot of times on an intraday basis comes down to when are certain key participants getting into the market, and what does that look like. Volatility will help you understand what that looks like. So as we come down and we see this contraction, prices are having a hard time going down. Volume picked up, but prices didn't go down. Maybe there was some limit orders there, maybe some aggressive buyers came in because we're at a reference. We've broke the Asian low, so they're like, hey, this is, we're outside of value, so to speak. Let's buy up. So then we get another candle to the upside, and this candle has more volume than most of the candles, no, actually all of the candles prior to it for the London and Asian session. So for most people, that is a big deal. And then afterwards, we have volatility expansion on the next candle, which actually closes on its high. This left us previously with a wick, and the candle closed halfway. But look at the volume. The volume showed is below average. There weren't many market participants. So then the next candle is what you might call an engulfing candle. But what's important is that we know the volatility was bigger than the last 3 candles. So even though contraction happened and we got some buy-in to the upside, we didn't get volume, and then we got expansion to the downside. That right there is a very powerful example of how volatility can be an indicator of where price really wants to go. Because right here, yes, you might say, yes, we ran into some sellers because we had volatility coming down here. You see, obviously there were some sellers. So as we went up on this candle, we probably ran into some sellers. So volatility, so prices got pushed back down. And then on the next candle, you would say, look, we actually went back up, closed on a high. Maybe we should look to the high side. But this volatility was greater than this one and any of the three candles before it on greater volume. If you look right here, this candle matches up with that volume, and it's greater than any of the volume prior. That is highly important. Now, what does this have to do with the news? It's all about the timings. I have a video in which I will link to in the corner where I talk about market timing and where certain market participants get in to initiate trades. And one of those times are the cash market open for the equities, the US equities, which is represented right here by this maroonish, you got reddish box. So with the timings in mind, if we look at the volatility we have coming in here, expansion only to the downside, and then the volatility back to the upside gets immediately reversed with volume as its confirmation, we then see contraction of volatility again. But remember, the market as a whole will normally tell you which way it wants to go. There's going to be participants on both sides, right and wrong, but it's the aggregate of, in this case, more supply than demand, and that imbalance leads us to go down. That's the way the market works, but volatility gives us those clues that that's taking place, and it's telling us also at what prices that's taking place. It's giving us areas of interest to look at. That's what makes that more important. Why does that make that more important? Well, remember what I said. Remember when we were over here, we see one period of volatility followed by another greater period of volatility expansion, which led us to break the Asian range low. And then we get a test back up near the halfway point of where we started that. And this is right before the US Open comes online. That's what this blue box represents. So if you look at the fact that we tested this area of interest where sellers came in aggressively, and then we get this action right here, we would be looking more to the downside. We wouldn't take this into consideration to go to the upside. So let's look at the 5-minute chart. And we have June 5th. We're going to scroll here. And if we look, we come down, we come up. And right here, after we make this, we break this low, this candle right here, that would have looked like possible to the downside, possibly we're not getting in anywhere, because it closed off its low and it's a very squat range. Also, the next candle, it looks like on huge volume, right? Big rejection tail, expansion to the upside, but it doesn't. We know it fails. Why? Where were our clues for this? Well, on the lower time frame, continuing, we still see nothing but mainly downside expansion. We're getting constant volatility expansion relative to the time frame we're on, and on the 5-minute you can just see it. It's just constant expansion, constant expansion, constant expansion with volume to match. Volume's increasing on some of these candles right here, and bear in mind the time of day. This is that first hour about before the US Open, which is a normal time for volumes to drop off. Knowing that is important, so you can take your volume readings into consideration with that caveat, because you're not going to get the same amount of activity just due to the fact that participants are just staying out the market, or I would say it's a common thing with switching over to a session where you do get a lack of volatility. The only main exception from that is when London comes on. When you're switching right before that, you get the Frankfurt Open, and there's a lot of volatility in there. That's probably the only exception, but you get a lack of volume when the first hour between London and US Opens, and right around the last hour before London closes, you also get a drop off in volume. So knowing how to read that in context will help you a lot. All right, so on the 5-minute chart, coming back, we see the test. We see this huge volume volatility increase to the downside, and we see that this test. Where do we get our clue that this isn't necessarily going to go back up? Well, the reality is we have to see this failure taken out, because this is a big bar on lesser volume, right? So the volatility has no volume to back it up, and that's a very important concept. VSA, volume spread analysis, also talks about this concept. So the volatility doesn't have the volume to match, and price is never able to take out this bar. And that's how you know that when this fails, even though it has a big rejection tail and we have expansion of volatility and there's volume to match, the context is there's no continuation of this type of price action to the upside. We don't take out this bar, which had big volatility expansion but low volume. That's how we know there's nothing going to the upside. That's how you watch volatility patterns. That is how you watch which price candles to pay more attention to as an area of interest. Volatility. As price goes on throughout the day, you'll see that volatility will tell you where you should be paying more attention to, and you won't get caught offside, and you will be able to add 2 trades when your setups show up with these particular clues in the background. So the timings are important. And if you see the US equities open here, the volatility was still to the downside. This was the last candle prior to the news coming out on this candle. And as you can see, we had a big volatility expansion. We had the biggest volume on the day. And what's more important for you to note is that it stayed in line with this volatility, that the current downtrend, it stayed intact. Now, how would that have given you a clue if price would have went the other way? Well, here's the thing. We've had increasing volatility, increasing volume to the downside more than the upside. Price could have shot up and price could have taken out this low. But if it didn't hold and we had a spike, then we know we would have just had a stop run, because the principles of volume and volatility are showing where market participants are going as an aggregate. So you can't forget to watch for that. Volatility is very important. It's price expansion. It's letting you know over a range of prices, where are people comfortable continuing to sell or continuing to buy? Is that still the behavioral theme in the market? So if all of this would have been retraced because this candle here would have decided to go up, watching how that closed would have been a big clue with the market context. We would have said, listen, volatility's been to the downside, calm down. At this point, maybe you're not even in the market, because you get out before news of that magnitude comes out, because you don't want to get whipsawed, and that's fine. That's good trade management. But knowing what's happening after, knowing what the price action in prerequisite to the actual spike, what that means, what that's been telling you, that will determine what you're seeing. It will help you interpret what you're seeing. And that is what I want you to understand, traders. The market needs to be interpreted, and volatility is one of the main keys to that. So just to show you, because this was only a trend day, that this works also in more range days. This is the prior day. This is June 4th. So this is the prior day. So let's just look at some key concepts here. Let's see. We'll pick the London Open. So the London Open, this red box here, we get volatility expansion to the upside. It takes place towards the Asian high, as you can see by this line right here, and there's no continuation. We do have increasing volume and increasing volatility, but where does it take place? It takes place near the top, and there's no breakout. There was no continuation, and the next candle tells you that. That's also a key volatility pattern. When volatility expansion takes place at the high of a range or a swing high, and you do not get volatility continuation on the next candle, that's a good clue that you're failed, or that this is a false move. Manipulation may be taking place, and volume is a big clue of that as well. So looking at this, we had the volume, so it didn't seem like it was manipulation, but then we had more volume coming on the next candle, which is a down candle, and that lets you know that, hey, there's some selling going on. But we'll wait and see. The next candle was an up candle, but look, very small squat profile, not much range. Volume was less than the last two. That's basically a no demand candle in VSA terms. And then what do we get? Immediate price volatility expansion with volume to match. I would have been looking for things to the downside from this point. I would have waited for price to come back up at maybe halfway into this candle, and I would have looked to come down. And as you can see, we got that when price came back up to the high here of this candle, even back up to where the selling came in. What did we get? More to the downside volatility expansion. Now, how did that change? Well, when we got volatility expansion here after this leg up, you can see volatility expansion to the downside happen. It happened on lower volume, but remember what I said about the timings of the day. This was about the last hour before the US Open, so we're looking at lower volume. That's to be expected. So we would just look for what's relative to the volume around that time, the half hour before and after. Here's the clue. There's no volatility expansion or continuation. So we start the move, but we can't continue the move. So that's another indication. Where do we know that, hey, but this isn't just going to come back up and come out? Well, let's check it out. We get volatility expansion here, all through here, and we're not seeing any real volatility continuation after this move right here. We've already taken out this swing high with volatility expansion. We have wicks to the bottom. Do we have increasing volume? We do here. This picks up only because we know that the US session is open, but here it is again. It can't come back down to where this volatility expansion had no continuation. It can't get past that point. This is where you're like, hey, this is a major point for me. This volatility expansion, this candle right here, where it had no more continuation, and then we took out that swing high, this is now your line in the sand, because this is where the initiation basically gave up. Or even you could come further, you could say, here, I'll use this one, but this was the line in the sand. And as you can see, every time price got back down here, there was rejection. After this expansion, we had periods of consolidation and then expansion. Remember the pattern: expansion, consolidation, expansion. That's how volatility works. And you want to note those patterns. You want to note the expansion, contraction, expansion. And then that'll help you not only stay out of bad trades, but close trades that may have no more potential in the way you've opened them. And also to put on trades where you're now comfortable saying, I don't see how price can get beyond this point based on the price action we have. Let me add to my trade. Let me get into a trade. And that's what you're looking for. So now we have the 5-minute chart we want to go to on this range day. We can see if it gives us clues earlier. So, okay, you could break it down on the 5-minute chart, and we can see that, yes, we have expansion, then contraction. There was no continuation after this volatility expansion to the downside after having this volatility expansion to the downside, starting from here. So, as you can see, when price came back around here to this candle, which is the last volatility expansion to the downside, it didn't get close, or rather, it got close, but it couldn't go through. So after we had expansion towards the end of this down move, we got contraction, we got expansion, followed by another expansion, followed by, what is this? Very low volume down candle, and then we got continuation. Here would have been a good place for you to get in. And you could have gotten yourself 42 ticks on oil. Or you could have taken up to the high, let's just say, and got 22 ticks. Because at the end of the day, you're probably thinking maybe it's going to stay within this range. It's not going to break out. The agent high is holding. And 22. And if you want to put your risk here, 25. It's a little less than a 1-to-1, but you definitely would have been able to work with something to that effect. So we're going to now go to the last time news was out, and that was May 30th on crude oil inventories. And we're going to look at the pattern on May 30th on crude oil inventories. So if we get news coming in right here, there's no real attempts to go up, and that's important. You have to look at the effort and the results, and volatility will help show you where those results are relative to. So this indicator is definitely a must-have, and if you want to know where you can find this indicator, just leave a comment down below. So again, looking at the volatility patterns, the biggest volatility candles to the upside was during the London Open. We had good volume. It was the biggest volume of that time, as you can see, going back. But it didn't continue. There was no continuation. And then it just came back down. And any other up volume candle didn't have any continuation. And it showed no sign of changing trend, no change in behavior, because any volatility down candle was bigger. It had more range to it, and it had volume behind it. So that's what we want to look at. Now, as far as the news, which came out right here on this candle, we have a pattern of volatility contraction. Volatility contraction, followed by some expansion, followed by more contraction, followed by expansion. It's the fact that this pattern is holding intact. It's the fact that this volatility pattern has not changed. This is how you would know which side news is likely to break to, along this context of we came up the Asian high during the London, failed, came back in, came back to the midsection, and came back out. That's all fine and dandy, but you have to know if volatility is actually holding and if volume activity is being supportive of it, because you can have the same pattern, but if you have particular activity where, let's just say at the end of a run, you have expansion with extremely high volume or low volatility or low volume on that volatility, you may actually get a reversal. The news may come and actually take you the other way, and it was just a markdown with no volume, no activity, getting people wrong-footed. That's the importance of volatility. There are more things that I'm going to bring with the volatility and how you can look at price inefficiencies and low volume areas using this same indicator. But for now, we're just using one principle, and that's the identification of expanding volume and contracting volume, and relative to the other candles or bars on your chart. We have so much more to say. This isn't it. Make sure you like, subscribe to this channel, because we're going to be bringing things like this to the trading community every week. See you soon. And remember, trade like a pro, you have to train like a pro.